Hello, I'm Wayne French from Carbon Tax and Accounting in Osborne Park, and to my left is Ryan Turner. Ryan's the Senior Financial Planner in our financial planning team here in Osborne Park. Tax planning is fundamental to wealth management. If you don't plan your holding of assets and investments properly, you could be actually exposing that to very high rates of tax, as high as 48.5%, which I'm sure no one wants to pay. And as we know, every dollar saved in tax is available for investment.
They think too much about pre-tax returns rather than post-tax returns. There are a few things you can do, like the 50% capital gains tax discount that you can receive. Seeing what tax structures you do use in investing, because is it best to have in your personal name or is it best to have a tax structure? Working out with the accountant about offsetting capital gains with capital losses, which is quite crucial within the financial year.
Hold an asset for more than 12 months and make a capital gain, that capital gain can be halved. So something as simple as actually deferring when you decide to actually sell an asset. It might be a few days before a full year passes. It might be worth just waiting that extra few days to gain access to a capital gain concession. The fundamental tax rate for superannuation is 15% on income and 10% on capital gains. It's even enhanced once you hit retirement and you start drawing a pension from your super. You actually start paying 0% tax on those earnings. So it's really important that you actually consider using superannuation as a tax structure. There's legislation that we define as the Small Business Capital Gains Tax Concession legislation. That's full of great tax concessions for people in business that are looking at selling. Really complicated though, so it's important that you get advice around that. Using the right structure to actually hold an asset when you first purchase it. The reason that's important is because when it comes time to sell that asset, there are various rules depending on the type of structure that's holding that investment as to how the tax will work on the sale.
Tax planning really is quite crucial around superannuation and planning for retirement as well, because there's so many tax benefits that people aren't aware of. I speak to many clients, especially over the age of 50, who don't understand what an allocated pension is and how it works, where there's 0% tax on the earnings and 0% tax on the income you receive. It can be as simple as what contributions you're making into it. Obviously, there's concessional tax contributions, a tax of 15%, which is quite often lower than the marginal tax rate that most people pay. There's also ways you can structure it too to make sure that your estate paying is tax efficient as well, which we work closely with Wayne here at the accounting team to make sure that the client's getting the maximum benefit. It's a great question. And in summary, you need to look at those key points we talked about previously. One is obviously using your superannuation as a tax vehicle. What structure are you going to hold it? What's the best effective structure for you? Looking at capital gains, how are you going to manage that with offsetting losses or gains?
It's really important that the financial planner and accountant are working together as a team. A lot of this strategy work does require both parties involved in that. You can actually achieve some magical outcomes if you're prepared to invest the time to work with the team that's wrapping around you to make sure you're holding your investments properly, you're investing wisely, and you're taking full advantage of the tax system in its current form.